If this bar ends up closing near its high, I'll go ahead and enter.
Order submitted.
Should be good enough. So I'm going to buy, trying to go for 5 points, which is good. We'll get out before these highs. You know, there's a bit of a wedge pattern forming, but unless we get a bear bar, then I wouldn't be concerned. I think there's enough people that would be buying below this bar. So I don't want to be putting my stop right below that. I think after these 3 bars, there's probably a good enough chance there's going to be a little bit more up. So when we get that a little bit more up, then we could make that decision then. Now there's a chance that this is that little bit more up. And so how this bar closes, we would make the decision off of that. But, just my point about the management is I'm leaving my stop here because I think if the market would pull back a little bit, but there's probably more buyers here, and those buyers would buy lower. All right, big picture. Today's a trading range. Some computers can be very aggressive, and they're just selling above everything, buying below everything, and they're scaling in, and they're making money the whole day. So I think the people that are doing that, they'd be buying below this bar. It's a bear bar, but there's a big tail on the bottom, and we just had 3 decent sized bars up. Probably at least a little bit more up. So I would not want to put my stop there. It'd be, if the market can get above this bar, I think that'll give us more information on what's going on. So it went above it. Now, are there going to be more buyers above that or more sellers? And I think the close of this bar will tell us a lot. I think if this bar closes poorly, I think we'll go ahead and just move our stop up to the break even. Or if it closes bad enough, I might just go ahead and get out of the close. But if it's a good close, then we'll hold on. So still 2 minutes in the bar left, but you can tell it was on its high there for a moment. So obviously, if it's like how it is now or better, I'm just going to stay in. But if it ends up with a big tail on top, I think I would just go ahead and exit and be done with it. So far, there have been more sellers than buyers above. But I still want to wait for the bar to close, and then we can make the decision. I've been saying this has been a very resilient market. Any kind of sell-off we have is usually bought fairly soon. So I could go back into prior days, but just looking at today, first 4 bars, I thought it was okay to sell below that, but it got bought. Midday sell-off here ended up being bought, which is what we're having now. So until that happens, it's probably best to try to avoid aggressively selling the market, especially when it's already had a pullback. So it looks like could have a pretty decent close here. Good. So that's about as good as it can be. It closed on its high and closed above the prior bar. We're getting closer to where I can move my stop up to break even. Normally I want to do it at least 3 points, but so we're there now. I think I'd rather wait for it to get up to like 4 or 4.5 before moving it up. And I say that because, once again, if the market does pull back here and go below this bar, there's going to be more buyers below that than sellers. So I don't want to put my stop right there. This is kind of that point where, what is optimal? What's the best thing to do? We're getting close to that point where it's close, where it's about 50-50 on what the best decision is to do. Would it be that much worse if I went ahead and moved my stop up now? No. But I'm just going to give it just a little bit more room and leave it where it is. I think if this bar closes, I'll go ahead and move my stop up. So say it closes like this, I'll go ahead and move my stop up and at least lock in a couple ticks. So I've been thinking this is probably not the environment for trading with wide stops. I mean, the first rule is make sure you always have your stops in. You never trade without a stop. But I think there's so much risk of a sudden, tweet, a tariff news, some other kind of news that is sudden and unexpected, and the market could just completely blow through. Let's say I put my stop way down here instead. Well, there could be one tweet and the market goes down 50 points. And, with that risk like that, then I feel like it's not worth having wide stops. I'd rather have my stop pretty close and have a smaller loss in that event. So, getting a pretty good test here of where we entered. And like I said, if there should be buyers below this, and if this bar closes something like this, I'll just go ahead and exit at the market and just try to get out, at least break even. We'll have to see how it closes and make a decision then. If it closes on its high or closes with a bull bar, I'll stay in. I think if it has any bear body, I'll just exit and get out with whatever we have. But when you're scalping, you want to, in my opinion, and from the data I have, you want to accept less risk, accept less of a pullback. Because if you're scalping, you have to have high probability. And if there's something showing you that your probability has weakened, then that changes the math of the trade. And so I found that for me, managing my scalps a bit closer is a better outcome. Of course, I'll miss some trades. I won't maximize every trade, but then I'll also reduce what I'm risking, right? So I thought it was reasonable to get out there. We had a bear bar. Now we're getting a second bear bar when I think the market should be, continuing up instead of getting bear bars like this. So to me, better to go ahead and just get out with a small profit instead of risking the market having a deeper pullback, which there's an increased chance of that because we are in a trading range. Market's been away from the moving average for a little bit. Might want to come back and test that soon because of the nature of the trading range. Compare that to if you're swinging, then I think you can allow yourself more room when you're trying to do a swing trade. So let's say you bought down here, for example. Not the worst buy, but if you bought here, there are reasons against. Let's just say you were long from here, and then you sat through this bear bar here. Now the market is above the moving average, which is good, but it's getting this bear bar. Well, if you're swing trading, right, you have to go for a large profit, which usually means a lot of bars. And look at any trend, there's going to be pullbacks in that trend. Take this trend on the open we had. We had a pullback here that lasted 4 bars, a little pullback here. Take this move down that we had. There's several pullbacks that are suspicious and scaring you out. This wouldn't be such a bad long. I bet a lot of people did go long there, and then they got trapped. But my point is that when you're swing trading, you can allow more of a pullback against you. Versus if you're scalping, you kind of have to do whatever it takes to maintain that high probability. And if the market is doing something that's not keeping your high probability, then you just exit. So also to think about the emotion and psychology behind the trade. So we're pretty close to where we got out. Let's say the market goes up and would have gotten the full 5 points. Do I go and cry about it and feel bad that I missed out? No, you can't do that. You just have to rely on your strategy and follow it. And consistently apply it. And let's say the market comes down here and it would have stopped us out. Then do I go, oh, I'm so great, I'm always right? No, that's the other side of the coin, and that'll mess you up too. So, find something that works, try to collect data to back it up. And then when you're having emotions or you're worrying about psychology, lean on the data that you collected. You say, here's the 100 set of trades I've taken. When I do this under these circumstances, then it's profitable. And that's the key to the emotion and psychology part of it. If you're just taking any kind of trade and you're just saying, I have the feeling that this is going to work, and you're trying to do things, trying to manage it in ways, or trying to take trades that you have nothing concrete to back it up with, then it doesn't matter what your emotion or psychology is. If the trades you're taking are a negative expected value, then you can't psych your way into winning if the trade is just a bad trade. All right, I'll go ahead and start the trade review. First entry was this fourth bar, and I thought it would be reasonable to think there was more down. We still had room to move an average, had 4 bear bars. I don't think there's anything wrong with trying to sell there. One thing that I was curious about, it's coming right up against this 200 moving average. Now, does the market think at this point that it is through the moving average? So we see these tails here. Are these just tests of the moving average? And then once it closes down here, that would be like it tried to go down twice, then went up, and now it's going below. That's kind of how I read it, was that it would be, it had already tested it twice, then broke above, now it's breaking below. Another way, which I guess ultimately is how it actually was that this was still just a test of the moving average, and it hadn't really broken below it yet. So it looks like this was still acting as support instead of breaking below it and then acting as resistance. So bar 5, we had this double bottom and a decent sized bull bar. I think that's okay to try to buy above for a scalp. I think the bar after it is also okay. The bar after it's probably a little bit higher probability as well. So on the open, we do expect a lot of reversals. So we have a bar closing near its high with a decent body, then there's a good chance that will be a reversal and have enough for at least a scalp. And we can see didn't take much time and pretty quickly went up and got a scalp. Now after 4 strong bull bars and closing above the last, yesterday's range, market probably has a little bit more up. And when I see this bull bar, I think that's okay to buy above as well. The only problem with it is starting to get a bit far from the moving average, but I think that's okay. It's still not too far from the moving average, so if you're buying above that, I think that's okay, and you are able to get your scalp there. You can probably swing there as well, betting that we have an early low of the day, double bottom at the moving average, and the market might continue up, especially with 6100 above. It might continue up and test that 6100. Wedge top, these 3 pushes. And I was considering shorting below this bar, this bearish doji, but that's the issue, is that it turned out to be more of a doji and didn't have too strong of a close. It was also getting closer to the moving average, so that was kind of reducing their profit potential from being able to sell below that. If you look at up here we had a first entry short, then market broke below, pull back a second entry short, but it's this bull bar. and I'd rather not be selling below a bull bar like that. If this was a bear bar closing near its low, I think that would have been okay for a short, and I would have marked that. But with it being a bull bar, I'd rather wait. So market made a couple different possible wedges. Here's one, 2, 3. And then here's another wedge right here. So first push, second push, and then pulled back, and the third push was not as low as the second. That's okay. It's still 3 attempts to go lower. Then when you end up here with is a second entry buy. So the first entry buy is here, and the second entry buy is here. Now, so those are good things. Another good thing is that it's testing the open of the day. So this open of the day is acting as support here. We could also say that it hasn't really broken through the moving average yet, so it might be a test of the moving average. My issue with this bar, and I thought a lot about this bar and this follow through bar. So pretty much this whole 7 or 8 minutes while these two bars were forming, I was thinking really closely about should I buy above here, and I just decided not to. And clearly I'm glad I did. So the reason I did not buy here, I felt like this was a very tight channel. Well, maybe not very tight, but it was tight enough to think that we'll probably get a second leg down. Right, so this is all as one move, and then pull back, then second leg. And this second leg is kind of a classic second leg trap where it looks like it's strong, right? I mean, these three bear bars are decent size, and they're consecutive and it's stronger than this, but really we're in a trading range, and then this is just a second leg that's going to fail. So the reason I wasn't trying to buy in here was because this was fairly tight, and there was a lot of selling in here. Bears never really gave up in here. So then this is just really a first attempt to leave that, and we'll probably get a little bit more down. Also, just the way it came up against the open, it tested the open, and I drew this white line in here, which marks the open. And when I see multiple attempts of the open, then I really start to think trading range day, and I think the open is going to be an important price later. And the market was below it down here, then it was up, and then I felt like it needed to spend some time back below the open. So, that's another reason why I was not wanting to buy here, because I thought the market would come back down and spend some time below here. After it did that and then broke above the moving average, held above the moving average here, tested the open again, and then bulls bought above either of these bars, and we already talked about that. But we have another secondary long here. So first entry, pullback, second entry be above this bull bar. Now I think this buy is weaker than this buy because we're higher up and what could be a trading range. I still think a lot of the time you'll still be able to have enough of a move up to be able to get out with a scalp profit, but it's just not as strong, especially following this tighter trading range. But with, like I was saying, these buys haven't working out so much lately, so it's not as strong as this buy, but I think it's okay to try to be buying above that. Like there are worse trades that you can be taking than trying to buy above that. If you did buy above that, then you need to be getting out below this bear bar. Why? Why should you manage like that? Well, we're high up in the range, and I really don't want to see too much hesitation up here. It's kind of like these bear bars down here that are going lower in the range. It happens pretty quick. And then, I'm really buying here, expecting to see the little pop up. And the second bar was good, but then when the third bar is stalling, then I'd rather just be getting out. So if you bought above and sold below, you'd basically be getting out with just a tick or two of profit. And that's all the trades that I have so far. Looks like in the last hour, there's a decent chance the market will try to come down and test the open. That's what often happens when the open has been an important price all day. It continues to be an important price. And so we'll see if there's a little sell-off here at the end of the day to try to get back to the open. So I hope you guys enjoyed that review. I hope that trade was helpful, showing how I manage it and my thoughts on it. I hope that was helpful. And if you guys have any questions, let me know in the comments. And see you guys tomorrow.